everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is one of my favorite types of videos that I do, but I do want to talk to you a little bit about this, and I'm also going to ask you for some help. I'm going to need a little help here. This is what I call my subscriber series. I get a lot of requests from subscribers. Unfortunately, I can't do all the videos that all the subscribers ask for, but there's another problem that I just want to make sure everybody's aware of. Number one is, when I do a subscriber request video, I'm going to look at it strictly by the numbers. I'm going to look at it through the lens of the FastGraphs Fundamentals Analyzer software tool. And this is a very powerful research tool that allows you to see fundamentals first, stock price second, if you will. And it's all about looking at the businesses behind the stock. And it's probably one of its most salient features, at least in my opinion, the thing that I like personally about it the most, is that it really enables me and empowers me to make a decision whether I'm even going to spend any time researching a stock, deeper than just looking at the fast graph. So it's really the first step prior to a more comprehensive research and due diligence process. But I got something else about this also. This subscriber request series, I need your help. I want you to, if you all don't mind, going down into the comment section and go ahead and placing a vote. I want to do this regularly. I want to do the subscriber request series regularly so subscribers know that every Monday or every Tuesday or every Wednesday or whatever your favorite day of the week is that you'd like to see them, or pick a date and I'd like to start doing a regular feature about subscriber requests on that day. We'll call it today, is Tuesday, so we're doing the Tuesday subscriber request series. I also want to point out that when I'm doing these videos, I've not necessarily conducted thorough research on them. I'm simply going to do what FastGraphs tells me or talk to you about what FastGraph is revealing to me. Like I always say about FastGraphs, we don't dictate valuation, we reveal it. So in this series, I've been asked to talk about the Chinese stocks Baidu and Alibaba. So I'm going to go ahead and get into those. I haven't looked very deeply into either of these. They're both growth stocks, but it does give me a chance to feature some of the real important features about FastGraphs as far as investing in growth. So let's go ahead and look at Baba and Baidu. I'm going to start here with Alibaba Group Holdings. This is the Amazon, if you will. The Chinese Amazon is referred to. The infamous Jack Ma started this company. It's really a major competitor to Amazon, but it primarily controls the Chinese market. All right, so it was established in 1999. Jack Ma, an English teacher from, I'm not going to try to pronounce the name, in China, was the company's founder, and he shared a belief that the internet could level the playing field by enabling small enterprises to leverage innovation. So he's all about helping small businesses in China sell their wares. So I want to look at this stock from the numbers. We're going to start here by looking at the all-important adjusted operating earnings. And what I want you to see here, first of all, is this company's grown earnings at a very high rate of over 26% a year. Consider the average company grows 6 to 8. That's very, very fast growth. The company's A+ rated and only has 10% long-term debt to capital. It trades at $267.85 a share, yesterday's close, has an earnings yield of 3.73%, which I would normally consider low, but I want to point out this is a growth stock. So one of the things we're doing here, we're using Peter Lynch's famed formula for fast growth. The PE ratio equals the growth rate. So you notice the company's growth rate here has been 26.02%. And so we're drawing the orange line, which is a PE ratio line, if you will, a multiple. And you'll notice that if you look at the bottom of the pop-up, anywhere I touch the orange line, that would be a PE of 26. Now the idea here is that we're investing in the business and not trying to trade the stock. So, in theory, where the business goes, the stock price should follow. So let's now add monthly closing stock prices to the graph. And what you see here is that the stock price generally goes where the company's earnings go. Now, the company went public, back in the beginning of 2014, and like it usually is the case, and gives me a chance to talk about this a little bit. Companies, when they initially go public, usually end up with a nice surge. As you can see here, Alibaba ended up going up about 26%, from September of 2014 when they went public to November of 2014. So that was a big pop. But then over the course of about the next year, that 25% initial gain turned into about a 47% drop. And I want to point that out because be careful buying IPOs. There's a lot of IPOs, hot stocks coming out right now. And what happens is everybody gets all the hype and hysteria, gets all excited about them. But it's been my experience, and I can't say this for every IPO. However, I can say anecdotally for the vast majority I've looked at, you're better off giving the company 6 months to a year before you buy the stock. But anyway, here you'll notice that the stock ended up reverting to the mean and came. You could have bought it at a 24 PE on September of 2015. And from this point, had you bought it to this point, it's trading now at around a 26.79 blended PE ratio with a 26% growth rate. So it's trading at about its growth rate. And I want you to notice that you could have bought it at a 24 PE. The company's PE has expanded just slightly to 26.79. It tracked the 25% growth, but it ended up giving you a 32.5% compound rate of return. Now, had you bought it on the original day the company went public and held it, because you were overpaying for it slightly here, your rate of return only drops to 19%, which is still obviously an exceptional rate of return. Because when you're looking at a stock that's growing fast like this, you're going to participate in that growth. Now, you got to be careful. Valuation, really changes your rate of return dynamics. Here you see a case where the stock, the market got overly zealous, the stock got overvalued, traded at a PE of 41. But the real beauty of a fast-growing company that's generating this 25% plus earnings growth, had you even bought it then, which would have been a less than optimum time to buy it, you would have still made 9% per year. Had you been smart enough to wait approximately a year and buy the stock, your rate of return goes up to 37% a year. So valuation matters, and it matters a lot. Now, I'm looking here only at the history of the company. It's a very fast-growing company. Let's look at what the future expectations are. There are 50 analysts following the stock. It's very widely followed. They're forecasting 39% growth for this fiscal year, which, by the way, ends March 31st. So we're coming to the end of their 2021 fiscal year, if you will. Then the 51 analysts, there's actually one more added here, expect 16% growth next year, followed by 24% the following year. So this stock falls within the valuation corridor. I would call, based on future expectations, assuming that they're correct, I would call Alibaba, fully valued. It's still within the valuation corridor, which we represent by these 4 orange lines here, but it's on the upper end of fair value. It's not extremely cheap right now, but it would still, bought it today, would give you a double-digit rate of return, averaging about 13% a year if it traded at a PE equal to its growth rate by the end of 2023. And that's how this works. Now, if I look at the normal multiple of this company, it's historically traded at a PE of about 32. If it trades at that, if it held that normal PE, you could make 31%. These are what-if scenarios. This is something that's very important. I always believe in running the numbers out to their logical conclusions. But if I look at the historical PEs, and again, this is a young company, you can see that the stock has traded at 30 multiples for most of its corporate life. More recently, it got down to 29 times earnings, 28.98, and then its most current normal PE is 26. As I pointed out, 26.79 as of yesterday's close. So you are buying this stock at a normal growth. That can hold. So this is I might call this a best case scenario. I might call this a rational case scenario or a mid-case scenario. And of course, the worst case scenario would probably be that we get the PE go down to 15 or 16 times earnings, which is normal for most stocks, and you could then ultimately lose money. But this is a very interesting company. It's reasonably valued right now. It's not necessarily cheap, but it's attractively valued relative to its forecast growth going forward. And it's also relatively, fairly valued relative to its history. I'm going to add the normal PE here, and this now gives you a range of valuation. So based on its normal PE, how the market has normally valued the stock, you could argue it's at the low end of its valuation range. If you're looking at the intrinsic value calculation, which is the orange line, it's on the upper end of, or it's fully valued. It's on the upper end of its fair value range. I want to say that clearly. It's not overvalued. It would still be very attractive value because this is a strong growth stock. If you feel good about investing in Chinese stocks, this one is A+ rated, only has 10% debt. So that's a very interesting company to look at. As I said, you can go out and do further research, but looking at it strictly by the numbers, the stock looks attractive. Now, moving on to Baidu, which is kind of the Google of China, if you will. This company also has a very strong growth rate, actually stronger, but this is a little bit misleading. We've got a 46.37% historical growth rate looking at this company going back to 1205. Now, there was some really big growth here in these first couple of years. So if I shorten this time frame on this graph, now I've got a 26% grower, which is similar to what we saw with Alibaba just a minute ago. Now I put price on the graph, and once again, I see this very strong correlation between price and earnings growth. The price was pretty highly valued back here with very high PEs in the 60s, but even had you bought it there and held it till today, you would, make about an 8% growth rate. Had you been smart enough to wait till the stock became undervalued and bought it and it's slightly overvalued, now your rate of return balloons to 18%. So the point is, valuation matters, and it matters a lot. It wasn't too long ago that this stock got extremely cheap. What a great time to be investing in this stock when you could have bought it at 12 or 13 times earnings. And you can see now we've had, just since May of 2020, we've had this enormous run up. You could have made tripled your money virtually in less than a year's time here, because you were able to buy this stock very cheaply. Now, growth rates going forward are kind of interesting in this example, because now we're looking at another widely followed stock, 35 analysts, but we're looking at maybe a more rational 19% growth. That would indicate that the stock is overvalued. If I looked even at the normal PE of 20, and this stock, if I look at its historical PEs, there were times when it traded at very high PEs, but as you can see over time, it's kind of drifted down into the 20-ish PE. So if I'm using a 20 PE here, I still would have a negative rate of return. That would be the risk of buying Baidu today. That's a great company. It's just gotten a little bit ahead of itself. The time to have bought it would have been a year or so ago. But again, this is a subscriber request. Every fast graph tells a data story, and the data story here is that, if you buy this stock at the right price, it could be a great investment. But this is one that I would, hold off on. These are both growth stocks. Baidu only has 24% long-term debt to capital, does not have a credit rating. That simply means they didn't apply to one for one, so Standard & Poor's doesn't give a one. It's a $98 billion total enterprise value, $85 billion market cap. In contrast, you're looking at Alibaba, a much bigger company at $724 billion in market cap, total enterprise value of only $704 billion, almost approaching $1 trillion. Two very interesting companies in the Chinese sector. What's really I found fascinating about these, they look very similar to their counterparts here in America. They're both very fast-growing, very successful companies that are, essentially participating in the modern world, modern commerce today. Baidu for the search, Alibaba for the e-commerce. Anyway, this has been Chuck Arnold saying, hope you like this. If you like this video, by the way, don't forget to like it. Don't forget to ring the bell and share it, because I'm going to be doing these subscriber requests. I'm going to do as many of these as I can. Again, I apologize in advance if I don't get to ones when you ask me, but I'm going to do these on this basis. I'm just going to give you a by the numbers look at them. But anyway, this was my first in this new series. Please vote. Please let me know what day of the week you'd like to see the subscriber request, and I'll do what I can to see that you get subscriber request videos on that day of the week going forward. Thanks for watching. I appreciate you as always, and look forward to my next video with you.